So, hello and good afternoon. I welcome you to today's weekly market outlook, especially here for Admiral Markets. No, a special webinar for Admiral Markets, especially, okay. Yeah, I hope that you had a very successful week of trading so far. We want to go through the markets, what to expect here in the upcoming week of trading, what happened over the last days of trading, especially here with a look at the DAX, which presented itself in a very bullish way, let's put it quite simply here, on the upside. Nevertheless, the overall picture when looking at the daily chart is still not a favorable one for the DAX bulls. And there's also the question how sustainable this move really is. We also want to have a look at today, what could move the markets today. In fact, there's only one data set. It's the inflation rate around Canada, which could get us some volatility. Also, very interesting technical picture. And also, we want to have a look back at the trading setup I presented. Some of you might recall that in the morning there was the real daily trading ideas, which I presented there on Euro JPY, and then fact, the setup now switched. We started out with a long order, but this order is now reversed to a short one, and I just want to give you an update on this and how the parameters just changed. Before we start, nevertheless, very important, we have to look. Have to have a look here at the risk disclaimer. Please make sure that you understand that Forex and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage, and that you should definitely consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money, and that you please fully ensure that you fully understand all risks involved. And it's also important and additionally worth mentioning that you please be advised to study the key information documents, short, it's KIT, from Admiral Markets in order to understand the nature, risks, costs, potential gains and losses of products offered by Admiral Markets. For further information, please reach out to Admiral Markets directly. I'll give you the contact details in a few seconds here. Then, as of August 2018, the regulation within the European Union differs for retail clients and professional clients. And in this context, it's something we all know as the so-called ESMA regulation. We want to have a look at this in a few seconds, what it means. Further information also, please contact Admiral directly. First of all, the question needs to be answered why Admiral Markets is a very good choice as a broker. Therefore, you have to, for example, a very great and very competitive trading conditions here when trading, especially the DAX 30. So here in Germany, Admiral Markets is known as the so-called DAX Experte. It's the DAX expert with a typical spread of 0.8 points during the main trading hours. German support. So there's many good reasons to consider Admiral Markets as a broker when you're trading the DAX, but this is also from a global perspective. With as far as I know, I think it's 18 offices internationally, and yeah, so it's definitely worth giving Admiral Markets, if not yet done, a deeper look here at the offering they have. Now let's come back to the ESMA and the important changes. So there's now leverage restrictions for retail clients with a maximum of 1-30 for Forex majors like Euro USD, Pound Sterling against USD, or also Dollar Japanese Yen, but also 1-20 for other currency pairs, so-called minors, or also exotic pairs like, let's say, GBP against the Canadian dollar, for example, and also 1-20 on CFDs and here on indices like the DAX and also on gold. And there's nevertheless a differentiation between professional and retail clients. And here there are several options. So if you're a retail client, then you have the leverage restriction, as mentioned a few seconds ago. If you recategorize and apply for professional status at Admiral Markets, which will be, by the way, then given a deeper look whether you really fulfill the criteria you need to meet here, then there's no leverage restriction. The interesting thing about being a retail client is that you have unlimited protection against negative balances. Interesting enough, at Admiral Markets, there is a protection from negative balances up to 50,000 GBP here, according to the policy from Admiral Markets. Also, for further details, feel free to reach out to Admiral Markets directly. Here are the contact details. And now, this is me. And here at the next slide, we want to have a look at the agenda, even though I already mentioned it at the beginning. First of all, we want to answer the question, what are the key economic events in the coming trading week? We also want to have a look what's the current bias in the FX, equity, and commodity markets. Bias, especially around pound sterling, for example, is currently everything around Brexit negotiations. I have a strong feeling that we are not yet done, by the way, in pound sterling on the upside. So far, it played out really well, what we presented here last week. You probably recall that I said there's a good chance that we are about to see a potential short squeeze, which could bring us in pound sterling against the USD back towards and above 132. In fact, in the morning, yesterday, it wasn't in the morning, but yesterday already, we pushed towards 133. And it's not only that pound sterling has some squeeze potential here if negotiations go well for UK, but also for the Eurozone. But on the other hand, it's also that US dollar is extraordinarily weak currently, in my opinion. And I would just want to present you why I come to this conclusion. And sure, what we want to answer is which trading opportunities may arise from all this. And now let's switch over here to the platform, trading platform, and therefore, first of all, have a look here at Euro JPY. I promise it. And I, by the way, closed the document already, but I want to reopen it. 1 second, please. Where do I have it? Where do I have it? Where do I have it? Here. I want to give an update here on the order, since it is now a different one, slightly changed, in fact. So you probably, if you haven't seen the webinar, feel free to check out the YouTube channel from recording there. And so that was the setup we presented there. And as you can see here, it's an entry long, but this changed now to entry short. So we have a setup based on the Asia range in this case. So it's similar to the open range breakout setup we present for the S&P 500, for example, but also for the DAX. We already presented it several times in several educational webinars. And you can also adopt the parameters to the FX market. In this case, we did it for the Euro JPY. And as you can see here, now it's a short order and you have to adopt accordingly. Now we're trading the break on the downside. So which is this one here, 132, even though the overall risk stays the same with 65 pips, because the stop is now placed at the high of this range, which is 33.13. So the risk stays 65 pips. And now we have to obviously also adapt here the target on the downside, 111 pips. That means we're going down to 131.37, even though the risk reward stays the same. And now we have the short order entered into the market. Let's see whether it's triggered or not. What we can already say is the hit rate of this approach has been quite well over the last 3 months. It has been, by the way, really well for the last years. We're talking about history here of a backtest history of over or around 10 years, not over 10 years, but around 10 years. And it has been an extraordinary well approach here, in fact. And so far, we're doing fine, even though the hit rate stabilizes at the level we should expect. So the hit rate is around 40 to 48% over a very long time span. But the payoff ratio has been 1.3 around to 1. And currently, we can see it here at 1.14 to 1. So that means that currently, if we see the market moving in our direction, it usually does not push aggressively in our direction as we should expect it to push, even though we're still ahead already after 3 months, which is a very positive sign. And yeah, let's just follow the trend. So currently we made it back from a short dip here on the downside, back above this line of 0, so above yeah, let's call it the watermark. And yeah, so far everything's fine. The interesting thing is, by the way, something I haven't mentioned here, but I can say that on the long side we did extraordinarily really well, while on the short side the results are not very, very positive. So the main reason, by the way, the result is that's called only 3%, though it's very impressive already. But nevertheless, the main reason is because the short side does not apply out so well over the last weeks or months, in fact, in Euro JPY. Therefore, it's not only true, by the way, Euro JPY, but it's also true for other currency pairs like Euro USD, for example. So let's have a look here, for example. So we have seen some strong moves on the upside, as you can see here, there, for example, but it was on the upside. So when we had trouble with this approach, it was during a time when the market pushed slightly on the downside. Yes, nevertheless, there was more kind of a choppy market environment. It wasn't really a strong move, but it was one move here. That was the 14th of June. And from there, it was more like spike on the downside, and then the market traded back. That was different here. As you can see, that's the end of June and into the month of July. There was a trending structure here on a daily chart, which can clearly be seen on the hourly chart then too. The same is true here. There's also a trending movement, and it's not sad that it doesn't or didn't work out well on the short side. Nevertheless, it played out better on the long side. So these conditions were from time to time at the lower time frames quite difficult to trade. Okay, and when the market then decided to push higher, it was really nice, smooth trending in one direction, and that's something which can also be seen in the performance if you divide it by long to short trades here. And nevertheless, even though it's a short one, and we weren't really successful with it over the last 3 months. Let's just hope that we'll get to see kind of a, let's call it a mean reversion here, and the short side plays out well too. So far, the hit rate is somewhere around 40%, should be around 50% too. So we have something to make back here, let's say. So, okay, that's it around the Euro JPY trading. Now let's have a look at the markets from a research perspective. Start with the DAX here. Have a look at how things are developing here. As you can see, we've seen some very strong days. The last days of trading were really strong on the upside. And now the question I have is this a sustainable move? And the reason for my skepticism is very simple. So far, I mean, we could easily explain this bullishness in the equity markets, in the DAX here, by saying, well, it's because Brexit negotiations are going well. We are talking about the DAX. It's the German index here, and we are dependent on our business relationship, trade relationship with United Kingdom in this case. So to make long things short, if the Brexit negotiations give us a tendency towards a soft Brexit, where there will be a negative impact on the UK, but also on the European and also on the German economy based on the Brexit or resulting out of a Brexit. Nevertheless, a soft Brexit would mean that this impact is not as negative as expected. So it should usually result then in a pullback on the upside here, in this case in the DAX, respectively, probably in a pullback or in stronger run on the upside in the Euro, in the GBP. In case of the DAX, the thing is now that so far, I somehow doubt that this has something to do with each other, because on the other hand, we could easily argue, well, if the euro, as it does currently, pushes back towards 118, for an export nation like Germany is, this is then on the other hand negative, because a higher euro usually means not necessarily big difficulties here around trading in general, but nevertheless, it should have a negative impact to some extent. So usually you should say in the current market environment, usually a stronger currency should weigh on the performance of the equity indices. So there should be a negative correlation. So now the question is, okay, where does this push come from on the upside, especially yesterday? Therefore, let's have a look here at the 5-minute chart in the DAX. And by the way, you can perfectly see, by the way, why I skipped this setup in the morning on the open range in the DAX. That was a discretionary intervention. That was also something I mentioned during the webinar in the morning, the real daily trading ideas. I said, be really careful, because I don't think that this is a sustainable move. And after 1 p.m. German time, and look at the watch currently, it's 1:20. It's there's a good chance that probably we are getting to see some losses, and the DAX will give back some of the gains from yesterday, because this move is, or seems to be, mainly driven by the triple witching today. It's so-called Hexensabbat in Germany, so triple witching. It's the third Friday in September, as you have triple witching on the third Friday every March, June, September, today, and then also again in December. So yesterday, that move here was probably driven by hedging from market participants who got caught on the wrong foot. So already in the morning, or yesterday, yeah, already on Wednesday in the evening, when I prepared my outlook for the next day of trading, for my trading for Thursday, I said, well, I see the market somehow capped at 12,300 points. I don't think that we can make it above that line. If we do, nevertheless, there was still a slight chance, even though I wouldn't have given it a high probability, but I said, well, then probably we get to see a squeeze up to 12,400 points, probably. But chances were low, and after we drifted into the day then here on Thursday, was that we've seen some losses here shortly after, that this wasn't really a sustainable move. It was a really thin market environment, but then things changed, and the market, the DAX in this case, was driven higher, effectively drifted higher, and into the afternoon, early evening, you could see that the DAX started to really squeeze higher. So there was no real seller left, but it seemed as if sellers were just stepping back and leaving the DAX drifting upwards. It's not really like a squeeze with big green candles here. Nevertheless, when following the price action yesterday, you could clearly see that there was really no one really willing to sell. And the question now is, why is that? And the same is, by the way, also true here for today. Same happened in the morning. We were trading around 12,380 points, and we clearly saw some squeezes on the upside, but obviously this move wasn't really a sustainable one. So what happened there? And therefore I prepared something, and you can, by the way, check it out yourself. It's data which is available completely for free on the website here from the Eurex. That's a big exchange in Germany where the FTX is traded. This is the underlying asset here when we're talking about the DAX CFD, DAX 30 CFD. And there, the website, it's also available in English, is listing such stats here, and it looks overwhelming at first moment, but in fact it's very easy to understand, because the only thing we're looking at, the two columns we're looking at here, is the left one and the right one, and that's something I prepared already, and I hope you can read it. Here it reads strike. It's the strike price of options, in this case calls, and here it's an OI. It's for open interest, and it's showing the interest of market participants at a certain level here into this triple witching today. And this data is in fact from yesterday in the evening, respectively, and then you can already see that this is the next column here. This is the one, how much contracts were traded that day. And you can clearly see that's the highest one, respectively, the 12,400 level is close to being the most traded level here. And what does it show? Well, it shows that market participants obviously started or had to hedge their exposure into the triple witching today after the market reached and broke above 12,300 points. So to probably give you a better idea of what I'm talking about, therefore, we have to make sure that we understand what's the I just know the German word, by the way. It's Auszahlungsprofil. It's a payoff. Yeah, probably payoff gets the job done. Well, if you're buying a call option, okay, you own the right to buy the underlying asset, in this case the DAX, to a certain price, even if the market is trading higher. That's usually what you call a call option. Therefore, you pay a price. This is the premium here, and this vertical line here is the strike price. Let's say this strike price is 12,300 points, okay, for our example. That means if the DAX now, today, is at 1 p.m. German time, when those options expire, trading at 12,400 points, for example, you have the right to buy the DAX here 100 points lower. So you're making a 100-point profit. Okay, that's the short version behind this. This is a cash settlement, so you're not getting delivered the DAX or every share of the DAX, but you get a cash settled in this moment. Okay, so now the question is, if you're buying this, then there must be someone who's selling you this option, right? And what's the profile, the payoff profile from this market participant? It's this one. So it's the complete opposite. So this guy is, you're paying this guy a premium, and he's making money as long as the DAX here. We can, by the way, do it that way. It's the same one here. He's making money as long as the DAX is trading below 12,300 points. He's making this premium. The only problem is if the market now starts to move above 12,300 points, then he's obviously starting to lose money quite rapidly, by the way, depending on how dynamically the market goes above 12,300 points. And now the question is, okay, what can he do to avoid losing money? And what he will do is he'll buy a product which has the following payout profile, which is here, this red line, and which can be found by, for example, buying the DAX. Okay, that's the simple idea behind this. And these market participants who try to hedge their exposure, and something you can see here, these were the market participants yesterday starting to buy the DAX from, let's say, 12,300, 330, 350 points onwards, and which drove the DAX higher over the day of trading. After those hedges were initiated, you could just see the DAX driving or drifting higher here, and no sellers being out there. This information, which I just presented to you, is available for every market participant. So everyone can imagine that this information, which I just presented, and probably in even more detail, is available to every big market participant, institutional market participant out there. Meaning those market participants looking at the DAX here have no real reason to sell the DAX at this level, let's say here, because they know there are probably plenty of players out there who have to hedge their exposure, and that's why they're just lifting the offer here and just saying, I'm stepping back somewhere here, 12,380 or something. I probably consider giving or selling the DAX again and offering the other side of the trade, but I'm not willing to sell anywhere here because I see that many market participants currently forced to hedge this bet they are having here when looking at the triple witching today. So, and this is, in my opinion, what drove the DAX higher. But what you can clearly see here is that this move higher in the DAX wasn't initiated based on fundamentals, but it's more like it's like a bet which doesn't work out. Respectively, it's a game between several market participants played at the options market, and that's the reason why I think that the DAX probably has another chance to push lower in the next week of trading. Even though I probably say we get to see a consolidation at an elevated level. That's probably the thing, yes. But nevertheless, as long as we trade below this purple line, respectively, this level here at 12,600 points, I don't see the DAX from a bullish side. But here in this case, I more consider another push down towards 12,000 points to be likely, even though I could imagine the DAX to close the next week of trading above 12,000 points. And this means that we are closing the month, third quarter of 2018 above 12,000 points. But the overall picture stays not very positive for the bulls here when looking at the daily chart. So yeah, that's it around the DAX and my outlook. So it's not very positive. Let's have a look now at the Euro USD. And let's have a look here at this strong zone, resistance zone on the upside, which we entered already in the last week, in the last days, especially yesterday then. And why I'm very skeptical if we get to see a strong pullback from here. Probably we get to see a pullback, yes, but let's have a look here at the hourly chart. You can see it already there. This green line is a potential trigger line for long engagements, in my opinion. So what I'm talking about is the following. Let's do it that way. I'd say that every pullback down to this green line is probably a potential buying opportunity which could drive us higher. That's something we can find around 117.20 around. Or let's make it a zone. It's 117 to 117.30. And everything, well, short term, it's probably here, these lows, but from a bigger time frame, probably this region around 115. Everything above 115 has a serious chance of another attack at the level around 118 and also a break above that level. So this is a potential, again, a potential trigger line, even though currently probably and into the week, now into the end of the week, the euro probably will give back some of its gains here. And probably correct it. Nevertheless, be aware that this region around 117 is definitely very interesting to watch and potentially a potential long trigger for another move higher, which will then probably take out this red rectangle here on the upside and push us not only above 118, but probably up to probably 120, respectively, probably towards 120, 150, 122. That's, by the way, resulting out of these lows here, which we marked at in February, respectively here in March, and then again in April. So these lows here. And so why I'm so positive for the euro, that has not only to do with the it is exactly the same for pound sterling, for example. So again, Brexit negotiations are very important for both the EU, but also for the UK, because they have strong business relationships with each other and a strong trade relationships with each other. So every deal they agree on, and which is especially around trade, positive for trade. Here, like I'm having an agreement on trade, like the NAFTA agreement, for example. That's one of the reasons why, for example, euro sometimes reacts also, not only euro, but also pound sterling, for example, when something is announced around a next step which is reached, or a next deal which is which the US and Canada agreed on, why it results not only in volatility in Canadian dollar, but also in the euro and in the pound sterling, because market participants think that what happens here around Canada could also happen to the Eurozone, and the trade agreement between the EU and the US, but also which could have then effects on the EU and the Brexit negotiation. So many things right now being discussed around those agreements here, trade agreements, are potentially volatility and market movers here, volatility inducing for markets. And so these negotiations are currently going okay, I'd say. So it's more likely that there will be an agreement, especially because Germany has some strong trade relationships with the UK, and I think no one in the Eurozone really, or in European Union, really wants Germany to lose its steam here, or to lose its momentum in terms of economic growth, since Germany is one of the only, if not the only, economy which is doing still quite well, and is as countering especially some not so good developments, not so great developments from an economic perspective, especially in the southern periphery, let's say, like Italy especially, or like Spain, for example. So now that said, this is already something which is potentially positive. But now let's come back to the US dollar, which has probably an even bigger impact. That said, by the way, you've already seen it here. Let's go back to the economic calendar. You can see it, by the way. You can find it on the website from admiralmarkets.com here when going to analytics and Forex calendar. If you scroll down a little, you can see that the overall calendar next week is quite thin, but then on Wednesday, big decision is ahead of us, lies ahead of us, the Fed interest rate decision. It's in fact a very interesting one. Well, no, it's not an interesting one, to be honest. If you look at it only from the question, okay, will they hike rates or not? Well, I can say yes, they will hike rates. Chances are nearly 100% that they will. Therefore, let's have a look here at the Fed Watch tool from the Chicago Mercantile Exchange. You can clearly see that chances are currently 99% that they will hike rates. So market is nearly pricing it by 100%. So the rate hike itself won't move the markets. But, and this is the thing, the question is, okay, what can we expect for the upcoming events here? What's around the rate hike in December? Currently, market participants are betting that there will be a rate hike. So you can already see it here. This is a September meeting next week. So the current rate is not even expected anymore. Currently, 90% are expecting a rate hike of 25 basis points. Some market participants are already betting on 0.5% or 50 basis points, in fact. Those are, by the way, those who are doing this mainly due to the fact that they can be sure if the Fed really hikes rates by 50%, 50 basis points, that they will be the ones being called from analysts like, from journalists like Reuters or Bloomberg. So it's more like betting on a black swan. We shouldn't expect this to happen here. But you can already see no one expects the rate level to stay the same. So it's a done deal that they will hike rates from a market perspective. If not, well, hell will break loose for the US dollar. And volatility is big volatility. It's definitely something the Fed wants to avoid. They mentioned this several times already in the past. So that's something you shouldn't expect. So it's more about what to expect afterwards. And there you can already see here, chances are already nearly 90% that they will hike a fourth time in December. If there is some kind of intention that they do not do this or do not plan to hike, or that they say, well, let's see if the employment situation is not well, if inflation, if the inflation outlook here diminishes or whatever. This is definitely something which could bring the US dollar under pressure, even under more pressure than it currently is. There's something really interesting right now happening. Yesterday, when this push happened here on the upside, this push higher went hand in hand with a significant pullback in the US dollar index future. But what's even more interesting is that 10-year treasury notes and yields on them stabilized above 3%, the highest level since May 2018. And what we know is that yields are usually yields are the reason why they give an idea of the attractiveness of a currency here. And if yields are rising and the currency itself is weakening, then this is a clear sign of weakness in the currency itself, which means every sign from the Fed that they do not plan to move as aggressively in their rate hike cycle as the market currently expects it, which means a dampening outlook here for the rate hike speculation in December, but probably especially around the speculations around the rate hike in 2019 then, is capable of letting the US dollar fall apart. And this then means nothing more that especially from such US dollar weakness. And this has something to do with a comment which was made by Mario Draghi last week at the ECB press conference, where he said to a journalist that the ECB won't tolerate an aggressive overshoot on their inflation target at 2%, and which is very hawkish if you compare this to the Fed, which said last time in their statement that they're willing to allow inflation to be symmetrical above 2%. And with this in mind, EURUSD has some serious, strong potential on the upside then, especially if the US dollar starts to weaken. It's not mainly or necessarily induced by euro strength here, but more like US dollar weakness. But nevertheless, if we break above that from a technical perspective, it's a very crucial region, as you can see it here. We definitely have room on the upside up to 120 and probably even above that. And so it could be that this is a very, very strong move ahead of us on EURUSD. And if the euro strengthens that way, well, this is something, again, which could weigh negatively on the DAX then and push the DAX again back towards 12,000 points. So around the euro, let's go over to like to not only use our correlation matrix here, but also, probably even more interesting, a webinar next week. And therefore, let me please give you a link that is something I really look forward to. I could imagine this to be a great event, not only because I present several of these great indicators, which you can find in the Supreme edition here from Admiral Markets, and which can be, by the way, downloaded there on the website for free. So 1 second. So first of all, here is the link to the webinar. And so if you want to download it, there you have it on the website. Go to the website admiralmarkets.com, and there go over to platforms, and there the MetaTrader Supreme Edition. And there you go to this, or you're guided to this page. Then we can free download it for the MT4 or for the MT5 as an Admiral client, and then you can use those tools not only, for example, this one here, the mini terminal, which I will present. By the way, we will trade the markets that day. We will use this tool here in the S&P 500. And I present here an approach, which you, by the way, can also read already on the website from Admiral. Therefore, go to analytics and the traders block. There it is, right at the header, at the top of the page here. There you can, oh no. You have to slightly scroll down now. Here, it's trading the S&P 500 with the open range breakout. And there, this approach is already introduced and explained, and we'll use the mini terminal for that. And now let's go back to the pound sterling, and now have a look here at this one, the correlation matrix. I will go into details here around this too. It's showing you the correlation between certain currency pairs or assets. Depends on whether you're looking at the FX market or in this case at DAX CFD, for example. But what I can say is that, for example, here USD and everything around bullish outlook I presented around the USD obviously is also potentially bullish for pound sterling against the US dollar of plus 96. So it's in German what you can read here, but it reads it's a strong positive correlation. So that means if one goes higher, euro goes higher against the US dollar, pound sterling they should be expected to go higher too. So, and yeah, so in fact, this is the case. And the question next week will be: do we get to see an attack at the level around the quarterly highs, which can be found around 133.50, 133.60 or so? So here, in this or around this red line, if there's such a breakout in the euro against the US dollar above 118, I think chances are really, really high, and probably even higher to get the even stronger squeeze then, because, and this is very, very interesting. 1 second. Let me just show you here the Commitment of Traders report on a website called barchart.com. It's also for free. It's available. Barchart.com is showing the positioning and the commitment of Traders report of the, in this case, large speculators. And what you can see is the numbers, by the way, they are updated tonight. So it's currently the data from last week, Friday, and they will be updated here then tonight. And they are here showing that there is already a slight reduction of net shorts, which by the way, could be found at the highest level since last year here in around May, I think. And so that is giving some short squeeze potential, and compared to the euro, we are still net short. So if you look at the same exact numbers for the euro, you can see that market participants here in the euro FX, they are currently slightly net long. So there is not such a, well, it's not dramatically, let's say. Okay, so what did I just click? 1 second, please. Usually it should open the same chart as I just opened. 1 second, just 1 second. Let's just click here again. There we go. Okay, so you can see it here. It's slightly above the zero, but still the market is not net short. So there's no such huge pressure, or slightly a lower pressure on those market participants here if the overall fundamental outlook for the currencies against each other changes. So currently, the US dollar definitely has a yield advantage, but if this slightly changes because of the depth of the market, there could be some really strong moves in one or the other direction. And again, so from this perspective, pound sterling probably has some bigger potential on the upside. And we're probably about to see a sharp move on the upside here too. So if you expect Euro USD to push above 118, long thing short, then you should also expect pound sterling against US dollar to push higher and take out the quarterly highs currently, which can be found around 133.70, 133.60, 133.70 here. Thing also worth mentioning, sure, when we're talking about the weakness in the US dollar and the current weak performance the US dollar is showing, we also have to make sure to have a look here at gold, which is currently trading in an astoundingly narrow range. And very interesting here, the make or break level on the upside, I see it around 1,214 to 1,215 USD per ounce. It's a very interesting line because it's trigger line. If we make it above that level, further gains should be expected in gold, and we should target or high 1,240 to 1,245 USD per ounce. I don't like to say in no time, but I think it will be a quite dynamic move if we push out of this range, especially if it will be yield induced, let's say. And therefore, it's not only the Fed which matters, but also here another chart around the commitment of traders report, the positioning in the yield market, in this case in 10-year treasury notes. So if we are net short here, as you can see, by the way, it's a record short positioning. So it's a potential sentiment extreme we see here. That means, on the other hand, that market participants are currently, large speculators are currently aggressively net long yields, which means if this does not play out, and again, it's very interesting to see that the market pushed higher in yields, but the US dollar can't profit from it. We are probably about to see a sharper recovery from this sentiment extreme here, meaning nothing more than yields probably about to push aggressively lower. And if this happens, there is a negative correlation to gold, which means nothing more than gold should shoot aggressively higher. So 1,215 is the line in the sand. If gold makes it above that level, chances are quite high that there's a squeeze about to happen in gold higher, 1,240 to 1,245 USD, and on the other hand, in the US dollar on the downside, equaling Euro USD, for example, taking at 118, 118.50. So yeah, plenty of very interesting things to watch next week, especially with the Fed around the corner. And so that's it so far from my end. I wish you a nice weekend. Take care and enjoy yourself. Talk to you again next week. Yeah, I really hope that you enjoyed this webinar. Appreciated it. Give a like on YouTube, for example, and that's it for mine. So happy trading. Watch your stops. Talk to you next week. Look forward to it. See you, and bye-bye.